Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. So last time I said that you should be wary about a correction, and that is happening right now. I also said that premiums on silver were going down, so correction was very probable. Let's see what the gold price has done. So we saw that we had a huge rise here from May, and now we are consolidating a bit, but surprisingly, this consolidation seems really flat almost. So this is actually a very strong base that is forming here. Um, so let's look at the gold forecaster index, which is based on leading indicators. And the last data point from August is very positive. You can see that here. It's almost the most positive since a decade. So this tells me that the gold price will be going higher uh, at the end of the year. So it's a very good time to buy on the dips now. Okay, let's go over the different leading indicators for gold. The first one is capacity utilization. Okay, we have seen that in August this was pointing up again. So the drop has now reverted to a rise here. So I expect that the inflation will come back soon. We will need to monitor this. If it goes up even more, then inflation will be back. Now, what's also very interesting to see is that bond yields are still in a downtrend here, which is very good for gold and which is probably the reason why the gold forecaster index is positive, because yields are still dropping globally. And when there are low yields, that means that gold will be a good asset to hold. Let's zoom in. Yeah, we had a small rise here, somewhere in September. We saw a huge rise here, but then it went back down. Okay, so this was also the period where gold was going down, testing resistance, and then from here on, gold got a bit again. Now, very important also to look at is the balance sheet, and I will talk more about that later on. But you see here that Federal Reserve is increasing its balance sheet again, and this is not a small increase, that is really large. Let's look at this from 3.7 till 3.9. That's 200 billion increase. That's a lot of money. So this increase in balance sheet will go into the economy and it will create inflation, probably with a delay of 1 year. And when we look at this chart, so the blue line is treasuries, red line is mortgage-backed securities. You can actually see here that the blue line isn't going up, the red line is even going down. So the increase here of the total balance sheet is probably due to the repo market. We will talk about that later. Let's look at the retail sales because they are a leading indicator for the CPI. So the blue line is going up. We see that retail sales are rebounding, and this should also translate in higher inflation going forward. So the trend is that inflation will be coming back. Well, the PPI, Producer Price Index, is not going up yet, but I expect that that will also go up soon because this is very volatile. This can go up in a moment here. Wages, also an indicator on inflation. Wages have been going up. That's the blue line here. So the red line should follow, which is the CPI. Now let's look at the real inflation, the real interest rate. So that's the 10-year minus the CPI, which is the blue line. And we see that real inflation is now trending back down, which is good for gold. So this blue line is trying to break lower here. And that's why the gold price is moving up. And that's because global bond yields are dropping. Yep, let's go here. Let's look at the leading indicators to check if the economy is doing well or not. We see that the leading indicators, the blue line, is still trending down. So that means that the economy is growing, but at a slower pace. But when we look at the leading indicator for the OECD countries, then that's the green line here. It is going down, but flattening out. So we are still in a downtrend, but probably basing here. So it could be that we won't go into a recession, but yeah, we will need to monitor this trend. It's not 100% sure that we will go into recession. Let's look at the credit risk because that will tell us a bit about GDP. So you see that the credit spreads are widening. So the green line is the 10-year bond yield, and the AAA effective yield is the purple line, and it has been widening since 2014. And you can see that here, since 2014, it has been widening, and it is still trending down, which means that the real GDP will be going down. When we zoom in here, yeah, the latest data point is pointing down. So it is something to monitor here. We also got trade deficit numbers, and we were at 55 billion trade deficit, which is not that bad. It's still in a downtrend, but it's not plunging. Trade deficit isn't growing that fast as I thought. I thought it would plunge like this, but it is actually more basing out here. It will maybe even go up. I don't know, but it's certainly not plunging. Nevertheless, when you look at this trend, the blue line should actually follow the red line. And the red line is the trade deficit, the blue line is the US dollar index. So I expect that the US dollar should be weakening, but it has been very resilient. It's not going up that fast anymore, but I expect some weakness in the US dollar going forward. This is the same chart with the budget deficit in it. So the budget deficit is the orange line here, and it's going up. The trade deficit is also going up, but at a slower pace. And let's look at the non-farm payrolls. So we got a new number here just today, and that's this red line. we see that it actually went up year over year, so that's not a bad number. So that's why the stock market was going up today. I had expected a larger plunge here, but yeah. So we can actually see here that the economy is not that bad. It's not growing that fast, but it's not plunging. Okay, so let's talk about some of the blog posts. Yeah, there was a lot of news about the repo problem here. So basically, let's go over this quickly. The problem was that the Federal Reserve has been decreasing its balance sheet, um, and that had some problems. There was a liquidity shortage, and we have found out that the cash balance at some of these banks, these large banks like JP Morgan, has been going down. Um, when we look, for example, at the liquidity coverage ratio, which was 115% last year, probably went down due to all that quantitative tightening. Um, for example, they lost about 150 billions here, and that costs all these liquidity problems. I will go into more depth later on. The silver price, yeah, we have seen that there are a lot of ETF inflows in silver. Also very interesting is how the US debt is exploding. So it went up from 22.6 trillion, and in just 2 or 3 days it went already to 22.8, almost 22.9 as of today. So we will quickly go over the 23 trillion in debt. So this is very worrisome. We also see that there is a contraction in manufacturing in the US. Any number below 50 is a contraction. And when we look at the exports of the United States, we see that manufactured goods are 60%. So this thing will have effects on the exports. And I expect that the trade deficit will continue to go down because of this manufacturing slump. A post about the seasonality of gold. Normally October is not such a good month for the gold price. Also because China is closed then, and then it always goes down, but you can see that when it goes down, it always goes back up. So I think next week we will see gold going up again when China opens. Let's see which. We also saw that Bitcoin crashed. I see that the cost per transaction is still not at this level here, so I expect that the Bitcoin price can go down some more to the 6,000 level. So do not buy Bitcoin, buy gold. That's better. We see that Germany is also in contraction here. The IFO index has been going down. A chart between the GLD stock and the gold price. We see that the asset value in GLD is actually not making a new high here. It's the orange line. But the gold price is making a new high here. So when this continues going up, then I think that the gold price will make new highs. That's going to happen. Retail sales, yeah, I talked about that. Okay, this is something I want to talk more about the balance sheet of the Federal Reserve. So this is basically the balance sheet. You have the asset side and the liability side. And when you look at bank balance sheets, there are always assets and liabilities, and they need to be exactly the same. So if one thing goes up, then the other also needs to go up. And basically, we have here in the assets side, we have mortgage-backed securities and US treasuries. You can find these here and here. And on the liability side, we have currency in circulation, which are those dollar bills that the Federal Reserve owes to you. And then we have the reserves. And these reserves are the excess reserves that are on the Fed balance sheet. So what is happening when the Federal Reserve does QT? So they are shrinking this assets side. For example, they're selling these MBS and these US treasuries. So when this shrinks, then this side also need to shrink. And considering the fact that currency in circulation is always going up, and that is also always the case. I can show you that here. Currency in circulation, this blue line is always going up. Then when you shrink this side, then these reserves or these cash balances will go down. And that's what's shown here. Currency goes up and reserves go down. And that's what the Federal Reserve has done. They are decreasing the reserves. That's this blue line. They were decreasing from 2015 until today, and they decreased it to 1.4 trillion. So that's what happened here. And then the repo problems started to happen because there was not enough liquidity. So what does the Federal Reserve need to do now? To get these reserves back up, it needs to increase the left side because currency in circulation will always go up. So this will always go up. So they will also need to increase back the left side. They will need to buy some US treasuries or mortgage-backed securities to get this side back up. Not only do they need to do this because the currency in circulation always goes up, but they also need to increase the reserves again. So you have a double whammy. And that's what's happening now. Um, yeah, you can see here the Fed repo here that is increasing here because they need to supply some of the liquidity to the banks. Now we have seen here that the cash assets were going down here for the domestically chartered commercial banks. Probably JP Morgan has something to do with this, and also for the small banks. Also, the cash level has been going down here. So that's where the problems rose. Yeah, so that's this. I hope you understand what this means. That means that QE is going to come and it's going to be big. Okay, let's look at this. Yeah, PMI, Germany is also in recession. Delinquency rates will go higher. Yeah, because we have a lot of corporate debt to GDP here. It's made a new high here, so this is correlated. We will see default rates rise. We also found that the the manufacturing inventories are making a new high. So that means probably that they cannot sell their inventories. They have too much of the inventories. That tells us that the economy is not doing well. You can also see this here. The sales to inventory ratio is going down, so they have less sales and more inventory, and that's correlated to GDP, which will probably be going down. I also posted a chart about the silver stock at the Shanghai Futures Exchange. So we saw here that it was topping out. So that's why also the silver price has been correcting. We don't see this China buying anymore. But of course it can come back, especially when the gold price goes up. Some info on the unemployment rate and the suicide rate. Interesting, that's a correlation. Then we have, well, this is a very interesting one. So we know that QE will come here. We have ended QT and we will start QE in November. Also, the ECB will be doing QE. And each time when we do QE, the yield curve goes up, goes positive. Each time when we do a QE, the yield curve will go positive. So I expect that somewhere here, the yield curve will go positive again, because the Federal Reserve is manipulating the short-term rates lower, while inflation is coming back, and that will push the long-term rates up. So you need to prepare for that. Inflation is coming back, and you need to be in hard assets. Okay, this was the dot plot. You see that the interest rates, the Fed funds target rates are all coming down here. So that should be bad for the dollar. Even though we don't see the dollar going down yet, it should be weaker. That's how it should be if it weren't the reserve currency. Yeah, this was a chart about the repo liquidity problems. We saw a spike in the SOFC rate, which is going to replace the LIBOR rate. And that's when we saw the repo problems. And here I created a chart that is correlated with the LIBOR rate. So the SOFC rate is correlated with LIBOR. Yeah, we see that these repo rates are actually a sign that QE is coming. I talked about that. This is a correlation between oil and stock market. So normally it's positively correlated. A higher oil means higher stock market. But at some point, the oil price will be a tax on the economy, a tax on the consumer, and then the stock market will be negatively correlated. That's typically when we come with a ratio of 1.4 here. And then we will see a negative effect on the stock market. Very interesting. Yeah, this was the spike when we had the drone strike on Arabia. Oil went up, and now it's back to where it started because they have repaired the installations and the production. It's actually even lower than it was. Uh, yeah, Tom Cloud talks about buying platinum. I think platinum will also be going higher. I've been checking if there were any Western central banks buying gold, but I haven't seen any of them buying it yet. These Hungary and Poland were old news. Germany is selling, Greece is just buying a little bit, France is buying a little bit, so we still need to see activity here. Then we have my prediction that the ECB would cut rates by 0.5%. That also came true, and that was positive for gold and, of course, bad for the euro. Something to take notice of is also the high credit card rates in the US, and also how it is not correlated anymore with the 10-year treasury yield. It's very interesting to see this. Normally, these credit card rates should be going down when the 10-year yield goes down, but that's not happening. So something is wrong here. Let's look at what China is doing. So the blue line is actually the China credit impulse here, and it is correlated with China GDP. See that the impulse has been going down since 2014. That's why GDP of China is going down. But I see here a small increase here. So maybe the worst is over. We will see. Yeah, there was some talk about maybe this rise here in bond yields that happened here quickly was maybe China selling treasuries. We will not know until they do it. So maybe in a few weeks we will know. Another correlation that I found between the OECD leading indicators and the S&P revenue. Um, the green line is going down, so I expect that S&P revenue is also going down, and that will not be good for stocks. Yeah, this is the chart that I created to check if the Federal Reserve was still doing QT. Actually, it was doing QT on mortgages, but on treasuries, it's now buying treasuries again. And the balance sheet is flat. Well, it was rising only because of the uh, repos that they bought. And here we have the Chinese yuan compared to the foreign exchange reserves. So there's a correlation here as well. And I think silver and copper also correlation here. When copper goes down, then the silver price will go up. You can check that here. Yeah, you can check this yourself. Also very interesting here is what China is doing. So China has a current account surplus and it went to deficit because they were transitioning into a service economy. So these blue lines here are actually tourism. So goods are still in a surplus, but they are starting to consume a bit, and that has had an effect on the current account surplus, which is declining here. So this is actually China transitioning into a more consumer economy. This is the put-call ratio, which is correlated with the stock market. Nothing special here. And this is, I think, the last post here about the non-farm payrolls. And then we are back. We are back to the last post here. Okay. So basically, we can stop here, and the conclusion is that the gold forecast index is really positive here. So I would buy gold on dips. We'll see if that will pan out, and I'll see you next month.